Okay, so this is Rob Keens, and my guest today is Rob Kirby. He earned a degree in economics from York University in Toronto and began his career working for an institutional trade desk and then for an international interdealer broker for foreign exchange and interest rate products. He most recently worked for Investors Group, the largest mutual fund in Canada, before leaving to found his current business, Kirby Analytics. He's also written a book entitled The Gold Suppression Movement. Hi, Rob. How are you?
Very good. And how are you doing?
I'm doing very well. Thank you for joining. I know that we were speaking a few minutes before the recording about your understanding of the history of the last financial crisis, and there was a lot of good information there. I wonder if you would share it for our viewers.
Yeah, sure. I think I started off just by mentioning a lot of people view the financial crisis of 2007, 2008, mistakenly, in my view, as the Lehman event. And the real issue on what 2007, 2008 really was it was a credit event more than a Lehman event, and the credit event, at least in the North American context, really began with Bear Stearns, who failed in 2007, and what it is that made Bear Stearns fail was they had hedge funds inside their company that held large amounts of subprime mortgages that were rated AAA by American ratings agencies. And the notion that a AAA rated piece of paper could fail, up until that point in history, a AAA rated piece of paper had never failed in the history of credit markets. And this was an astounding development, because what it did was, when AAA failed, it paralyzed the paper market, like the commercial paper market, which is essential to the conduct of the capitalist society we live in. Mm-hmm. Because the commercial paper market funds the intermediate sort of process of taking goods from, call it things from the field or from in the ground, through processing and manufacturing into finished goods that are sold to end users or consumers. And the way that stuff gets financed in our society is through the bill market. And when the bill market or commercial paper market seizes up, what it does is it throws a wrench into the spokes of capitalism, and it grinds the whole economic model to its knees. And that's what really happened in 2007. And the history there, oddly enough, was that Bear Stearns was pretty much singled out as being the holder of these failing or failed AAA rated subprime mortgage bonds. But the reality is, there was an experience before even Bear Stearns acknowledged having failed AAA paper, because it was a French bank, BNP Paribas, who before Bear Stearns had said that they had a significant amount of this AAA rated mortgage toxic waste, is what I refer to it as. They admitted they had it, and it had failed. The coupon payments weren't being made because the underlying mortgages contained within the pool that made up that bond had failed. So BNP Paribas, they blew the whistle on it first. And then Bear Stearns admitted that they had funds and they weren't performing or had failed, holding the same kind of paper. So, but the reality is, all the investment banks in America, whether it's Goldman Sachs, Morgan Stanley, Merrill Lynch, at the time, they were all loaded up with this stuff too. But I find it interesting that they wanted to blow the whistle on Bear Stearns and take Bear Stearns down for being insolvent, owing to having this non-performing mortgage paper. And the backstory on why Bear Stearns was chosen to fail is because Bear Stearns hadn't played friendly with the powers that be 10 years earlier in 1998 when long-term capital management failed. And when long-term capital management failed, long-term's chief legal counsel, a chap by the name of James Rickards, he summoned all the investors in long-term capital to a meeting in the New York Federal Reserve's offices. And this is where it was laid out to everybody how big a haircut everyone who invested in long-term capital, how big their haircuts were going to be. And one of the big investors in long-term capital in 1998 was the Bank of Italy. And the Bank of Italy, what they were doing, or what they had done, or the reason they had invested in long-term capital, is that they were trying to qualify for the euro, and because the euro had not yet launched. And the preconditions for joining the euro were laid out in a piece of financial regulatory framework called the Maastricht Treaty. And the Maastricht Treaty stipulated that countries had to have specific debt to GDP ratios satisfied before they could be included in the euro, and Italy wasn't passing the grade. So Italy's finance minister at the time, a chap by the name of Mario Draghi, who some of you might be familiar with, his chief advisor was Goldman Sachs. And what Goldman Sachs suggested to Mr. Draghi was, look, you guys have lots of sovereign gold. You could lease some of your gold. And when they say lease gold on a sovereign basis, it means the gold leaves the vault, it's sold into the market, and the proceeds are then invested for whatever aim the owner, beneficial owner of the gold wants to invest it in. And so what Draghi did is he instructed the Bank of Italy to lease gold. The amounts that I heard rumored were roughly 400 tons of gold. So it got leased, and the proceeds were invested in long-term capital. And as Goldman said, that this long-term capital was being run by a couple of Nobel laureates in economics, and these guys were described to Draghi in Italy as can't miss, and these guys are guaranteed money in the bank. And the idea was that the proceeds from the leasing of the gold that were invested with long-term capital would help Italy over the hump to get their sovereign finances so they would qualify for inclusion in the euro. Well, lo and behold, the gold was leased, the funds were invested in long-term capital, but long-term capital made a huge leverage bet on Russian bonds, and then Russia defaulted on those bonds. So now the Bank of Italy, or Italy, was out the gold and out the money. And if this had been publicly disclosed that this indeed had happened, Italy would have almost certainly have been excluded from the euro, and the whole euro project would have very likely been stillborn, as in no euro. And if you understand what the formation of the euro was intended to be from a globalist perspective, the whole idea behind globalism is to achieve at its end a one world government with a one world currency. And if the euro were to have failed to materialize, this would have been a huge setback, or maybe possibly a destruction of the globalist wet dream to have their one world government and one world currency. So this had to be done secretively, and this is why James Rickards summoned everybody to New York, the New York Federal Reserve offices, and they started talking about the haircuts. But the guys at Bear Stearns, they understood that there was a an issue with gold involved in why this was being done so secretly, and they were being asked to take a hit for many millions of dollars, and they thought it was ridiculous, and they bitched about it, that they were being asked to take a haircut because people had screwed around in the gold market, and they were having none of it, and they were bitter opponents to settling up this issue. So that put them in the bad books with the powers that be, and in 2007, Bear Stearns got their payback. So because this was the way that the officialdom said, well, you didn't want to play with us and you bitched about taking a haircut in 1998. Now you're insolvent and we're going to take you down. And that's exactly what happened. They were taken down when they were no different than the rest of the investment banks, American investment banks, who should have also gone down at the same time if these things had been based on a meritocracy, which they clearly weren't. So how this morphed into the Lehman event, which in my view, the whole situation with Shearson and Lehman was that they were they were loaded up with non-performing subprime mortgages, just like Goldman and just like Merrill Lynch and Bear Stearns, who had already failed. But I view the Lehman event, if you want to call it that, really was a means to recapitalize JPMorgan, because it was JPMorgan who took over the affairs of Lehman when they went down, and there was a massive cash infusion that followed into JPMorgan coffers, an insane amount of money. I believe it was $150 billion that flowed into JPMorgan's coffers as they absorbed the remnants of Lehman's enterprise. So that's a little bit of a backstory on where and how our financial crisis came from my point of view.
Okay, thank you. And I want to get more into where we are in the debt markets and where we may be today, considering what you've stated. But I also want to ask a question about Lehman's position in silver. Didn't they have a big position in the silver market, and didn't JPMorgan absorb that position when they took over Lehman's books?
No, what was alleged, Lehman Brothers, I've never seen any documentation whatsoever on Lehman's metals positions, and I don't even know if they were really a player. But what has been stated by certain people in the alternative press, they believe that Bear Stearns was short silver. I don't believe for a minute Bear Stearns was short silver. And the reason Bear Stearns would never have shorted metal is because they know firsthand and knew firsthand what the outcome could be if you got short silver or got short precious metal, because they remembered 1998. They remembered that long-term capital was taken down effectively because of a metal short, and it really wasn't a metal short. It was a leasing of metal, which amounted to a metal short. And so it's sort of like if you've experienced that putting your finger in a light socket gives you a very bad experience, why 10 years later you'd want to put your whole arm in a light socket is above and beyond me. And there is documentation available in the mainstream if anybody really wants to dig it, because I've actually written about it and I've documented it, which shows that Bear Stearns was long silver, and that's another part of the reason why they were taken down and why JPMorgan absorbed them, because JPMorgan is a serial shorter of silver futures and has been for a very long time. And after JPMorgan absorbed Bear Stearns, their silver short was reduced dramatically. Okay. So if you absorb something that reduces your short dramatically, you've absorbed something that was long.
Mm-hmm.
Okay, because that's the way the math works.
Right, that would net out to be less short overall, taking on the longs. Yeah,
and that's exactly what happened when JPMorgan absorbed Bear Stearns operations. Their short in silver reduced dramatically, which means they inherited or absorbed a long. So, and that actually makes sense, given what we know happened to Bear Stearns previously in their history. Vis-a-vis long-term capital and the Bank of Italy and all that stuff. So anyway, that's why that happened, and that's why it happened that way.
Okay, thank you for clearing that up, because I know there's a lot in the alternative media about who had the shorts and when they had them. So that's good information.
I know, yeah, but there's a lot of people that make statements and really don't do the homework to back up their statements.
Right.
And I try not to do that.
Yeah. So moving forward to today's debt market, corporate debt, it's in the mainstream financial media even now that there's a lot of corporate debt sitting on the edge of junk status, BBB status, and that even the current amount of junk debt that we have in U.S. corporates is very high. Of course, we know we have a lot of sovereign debt in the U.S. as well, and I've been writing articles on how much personal debt that everybody has in America. So where are we in the debt markets now? Is it realistic to say that we could be in a 2007, 2008 sort of state with the debt markets, and that we shouldn't believe the rating agencies and their sort of rosy projections, and that there could be a debt default somewhere in the future?
Well, I mean, yeah. The amount of debt in the world today is dramatically more than the amount of debt that was in the world in 2007 and 8. Mm-hmm. So to think that we could have a cascading round of debt defaults is not a stretch of the imagination. And I would suggest the only reason that it hasn't occurred yet is because interest rates have been arbitrarily forced to unnaturally low levels. Mm-hmm. And for many sovereigns, they're now playing with and working on the assumptions that their funding costs will remain negative, where people pay to have the privilege of lending sovereigns money for 2 to 10 years. Like there's $14 trillion worth of sovereign debt today with negative interest rates. Mm-hmm. And like on its face, that's insanity.
Yeah.
It's complete and utter insanity, at least in my view. And that is not a sustainable model. Because, I mean, assigning a negative value to capital is not, well, I mean, it's actually really in keeping with the whole philosophy of globalist mentality. Because globalist mentality views people like you and I as a disease on the planet. Mm-hmm. And they want to, and one of their key goals is to get rid of at least 90 or 95% of us. Because we've got a population on the planet in excess of 7 billion individuals right now. And the globalists believe that the right number for the world is probably 400 to 500 million, which means they want to get rid of an awful lot of us. Mm-hmm. Because they view us as, non-contributors. And I think it was Henry Kissinger years ago, he referred to us as useless eaters. Mm-hmm. So the idea that they would assign a negative value to capital, I mean, most people view negative interest rates on bonds. Well, that's a negative interest rate on money. But human beings are also like human capital. I don't know anybody who works for free. So, assigning a zero value to capital, in a sense, it's like saying or expecting people should work for free. Mm-hmm. But, in the real world, maybe in the globalist wet dream that works, but in the real world, I don't know too many people who work for free. I mean, there is volunteerism and there is charity, but, the largest percentage of humanity does not work for free. And capital should not be free either, because the whole idea of capital is that it's scarce and it needs to be carefully allocated. And when you assign negative value to it, people make very poor asset allocation choices. And of course, that sort of describes very well the world we live in today, because you look at some of the things that governments are funding, and you have to scratch your head a little bit, wondering why or how certain, white elephant projects manage to get funded. Well, the reason they're being funded is because arbitrarily rates have been set at ridiculous levels and unsustainably in the long-term levels.
Mm-hmm.
So that's really the nature of our world today.
Okay. I think the IMF recently, a couple of months ago, released a template for negative interest rate policy, and they're really releasing it for all the world central banks. So it's more of a worldwide template. And they were talking about creating two levels of money in this IMF blog posting. They were talking about creating an electronic money. It could be something that's run through the blockchain or some other version of electronic money concept, and then real cash. And what they would do was, when people put their cash into the bank, they would discount the electronic money by a certain rate. So let's say if they wanted negative 3% interest rates, you would put $100 into your account, you would have $100 in e-money, but that would have 97% of the value of cash. And that's how they basically would take that out of your account, and they would do it through the banking system. So I think the plans are already out there, not only in the bond markets, but the bank account system as well, to take negative interest rates global, if, the World Banks agree to that. I don't know if you had seen that or if you had comments on that strategy.
I've heard of such schemes, and I find it very interesting that with Draghi, Mario Draghi exiting as head of the European Central Bank, it's been rumored in the last few days that the most likely candidate to replace him now is Christine Lagarde, who is formerly the head of the IMF, or I guess still technically currently the head of the IMF. But I know just through some people I know who have interactions with her, she's very friendly towards the adoption of crypto money. And that would seem to me to fit very well with what you just offered as a possible place to where we're headed. And in terms of crypto money and where the world's headed with crypto money, I would point out that gold and silver have, in my view, seriously underperformed. And despite the notion that we have a number of people in the gold and silver community cheering on recent, I'm going to call them bumps up in price, I would only point out that since December, we've seen gold go from, call it 1,200 to 1,400-ish, and we've seen Bitcoin, which is the flag bearer for the cryptoverse. Bitcoin's gone from roughly 3,000 to 12,000. So Bitcoin is up by a factor of 4 since December, and gold's strapped on a walloping $200, and silver has basically been moribund at around $15. So the notion that precious metals are breaking out right now, I don't buy into it. And yet I still maintain the belief that ultimately gold, physical gold and silver, will be the go-to things, but officialdom does not want people to have that in their heads now. Officialdom wants everyone to believe that cryptocurrency is the next gold, and the proxy for that currently is Bitcoin. But the cryptocurrencies that will ultimately end up being the go-to in the digital world, I honestly don't even believe they're trading yet, but they're coming, because work's going on behind the scenes where countries are adopting crypto platforms, and a number of these crypto platforms that are being conceived right now and in my view very close to being ready to launch. These things will be backed by ultimately tangible stuff, whether it's gold, silver, or a mixture thereof. And I do believe that they'll be coming to a theater near everyone very soon.
Rob, do you think that there's going to be a two-tier money system? Because I agree with you on the cryptocurrencies. I think they're going to implement the blockchain and cryptocurrencies, maybe even Hashgraph as a second generation of crypto for people, and they're going to try to get rid of cash. The IMF, in the same article I was talking to you about earlier, said that they're trying to get people out of cash. But there are a lot of cultures around the world that are very cash heavy. Some Asian cultures, European cultures, and even the US still uses cash for a lot of transactions. And you said that you think that gold maybe back up that system, or one of the assets backing up the system. Do you think that the central banks are going to try to hold most of the gold for themselves and for the financial system, but they're going to give us the cryptos as money? Is that what's going to happen?
Well, I think they're going to try and force cryptos down our throat.
Mm-hmm.
And I'm basing that on observable price action that we have witnessed in the last 5 or 6 months. Like, I know that the central banks are big players in the cryptocurrencies already, because I know they have an oar in the water, whether it's Bitcoin, Ethereum, or a host of others. But at the end of the day, what they don't want to see happen is in nominal terms, the price of gold to rocket up. And so they've held it in check dramatically, while they've really let out the line in the cryptoverse and in Bitcoin in particular, because they want to be able to point at Bitcoin and say, why would you think that gold is the go-to thing? Look at the performance of Bitcoin. Bitcoin is behaving the way gold used to in the face of dramatic monetary debasement. And that's because we have these institutions like the COMEX and the LBMA, where the proxies of officialdom are allowed to sell unlimited amounts of gold that will never be mined, does not exist. And this is the way they keep, basically they keep sobriety in the precious metals arena, while cryptocurrencies paradoxically are allowed to run. I mean, I find it extremely amazing that a virtual currency like Bitcoin, which doesn't even exist in the real world, you can't sell a Bitcoin unless you own a Bitcoin, because the blockchain protects the integrity of being able to sell something that doesn't exist. Meanwhile, in the precious metals arena, very scarce, elements, gold and silver, which are scarce and you have to dig out of the Earth's crust at great expense, people are allowed to sell those in infinite amounts, and literally in amounts that never will exist. And I mean, to me, that's a complete and utter paradox. The virtual thing has the discipline imposed on it, while the real thing, people can sell unlimited amounts of it, and that is only because regulators are complicit in holding the price of the scarce thing down. So I mean, the regulators, I mean, there is commodities law which state that what occurs on COMEX should never be allowed to occur, according to law. But when regulators don't regulate, anything can happen. And so anything has happened. And the price of gold and silver have been arbitrarily and summarily suppressed dramatically. And that also is unsustainable in the long term. And there will come a day when that will end. And at the very end of the day, I do believe that gold and silver will regain a monetary place in our monetary system. And in nominal terms, the price levels will be much different than what they are today.
Okay. I got a couple of follow-up questions for that. When I was working at a currency broker, I got my Series 3 license, and I wanted to edify what you said earlier. In that Series 3 license, which regulates commodities and Forex, cash, they did state that the purpose of the markets were for legitimate hedges. So if, for instance, you were taking your corn to market, but you had to store it, you could take hedges in that market to offset any opposite direction price movements and reduce your risk if you're like a farmer. But what's going on in those markets is you have banks who don't necessarily trade in the physical metals, or they might, but they're trading amounts thousands of times larger than what they may be doing in the physical markets. And that is unlawful. And when I got my Series 3 license, the first thing I noticed was, wait a minute, what's going on in the Forex market? What's going on in the precious metals market? That's legally not supposed to be happening.
Exactly.
And you could see it in both markets.
Yeah, well, I mean, if you know the history of where commodity futures came from, they were born out of the need to give farmers support in terms of farming used to be a very difficult activity to be engaged in, because farmers used to take huge amounts of risk by preparing their fields for planting, buying the seed, planting the seed, and then in the fall when they have their harvest, they would never really be assured of what they would get for their harvest, which meant that they were taking crazy amounts of risk. And when catastrophes happened, or if there was a glut of a certain agricultural product come harvest time, speculators would drive the price of these commodities to zero, these agricultural commodities to zero, if they could smell the odor of a glut in the air, and it caused the ruination of a lot of farmers. And so along come the development of the futures markets. This way, when the farmers put their seed in the ground, they could sell some of their harvest forward to insulate them from any major price shock, and transfer the risk of farming onto the likes of financial people who are willing to take that financial risk, where the farmers just wanted to farm and be engaged in farming activity and not speculating on the price of end products a few months down the road. But so what's happened since then? Well, the commodities futures markets have grown, and many things that very likely ought not to have been futurized or ever been utilized the way they are today. They came along because of greed, and because of, in the case of gold anyway, the gold futures came along after the failure of the London gold pool, and after the United States closed the gold window under Nixon in August of 1971. It was shortly after that we had the emergence of the petrodollar, where the unholy agreement between Kissinger and the Saudis, where they would only sell their oil for dollars. And then shortly thereafter, we had the establishment of gold futures, which were actually pioneered in Winnipeg, Canada. The very first gold futures were, and they put them on the Winnipeg, which the Winnipeg Exchange in Canada was largely an agricultural commodities futures exchange. But they trial ballooned the gold futures in Winnipeg, because I guess they really figured that if it blew up and it became a mess, they could just say it was the crazy Canadians who did it. And of course, this is the way the powers that be in America, or the people that control the American dollar, absolve themselves of any blame and any finger pointing.
Yeah.
And it continues today.
In terms of the gold price you mentioned earlier, you didn't think it was really breaking out now, even though it got up to almost 1450 and it's trading above 1400. A lot of gold analysts are looking at 1350 as that sort of historical resistance line. What would you call a breakout in gold?
To me, I don't know. What's a breakout in Bitcoin? Bitcoin's gone up by a factor of 4. If we saw gold at $3,000 in a month and a half's time, I would say gold's probably broken out. But to see this piddling around with $20 here, $30 there, we see it go up 30 or 40, and then we see it smash down 30 in a day. Gold, in my view, hasn't broken out. Period. Just hasn't broken out. And you know what? We've seen it grinding a little bit higher. And I view that as a bit of a venting, because when you're suppressing the price of something arbitrarily, and there's a voracious demand for that thing in its physical form, you're going to be probably engaged in some kind of a rearguard action where you let the price maybe melt up a little bit to try and take the edge off of the physical demand. And that's more characteristic of what I see happening in gold and silver. They're allowing the price to just edge up a bit, and still intermingle days of hard down in price, because they're trying to make people not want the physical metal. And as we know, the Russians and the Chinese and a lot of the Asian countries seem to be very keen to this, because they're having none of it, and they have a voracious and insatiable demand for physical metal, and they don't play in the futures markets. So, like I say, the metals are the end move, but in the meantime, we're going to be force-fed a steady diet of, I believe, higher crypto prices.
Okay. And you mentioned the Chinese and the Russians. I think Adrian Douglas has come out and said he thinks the Chinese have upwards of 20,000 or 25,000 tons when looking at purchasing their own production, and also what they purchased off the market. And certainly, I think they're only reporting 3,000 tons, but we think they have more. People that have been watching that market. Do you think China and Russia are going to be the ultimate sort of nail in the coffin of what the cartel is doing in the West to suppress the gold price, or do you think it'll be more a revelation when, say, some of the currencies start to break down and the debt system breaks down?
Well, Russia and China are major players in the advocacy for basically, I'm going to say, gold is money. I expect that to continue and heighten. And what I see coming ultimately, and this ties back into the missing money, the missing 21 trillion, as Catherine Austin Fitts and Dr. Mark Skidmore have documented. And they did this documentation using the government's own data over a period of 1998 to 2015. And they did their investigations on the Department of Defense and HUD, Housing and Urban Development, two government agencies. And what they found was in their books, they found undocumented movement of money to the tune of 21 trillion bucks, where they don't know where it's gone. So, and I mean, I know both of those people, Skidmore and Catherine Austin Fitts, and they're brilliant at what they do. And they believe that this money was created, and they don't know where the money's gone. I have my own ideas about where that money is gone, but I do believe absolutely wholly that the money was created. I refer to it as black, dark dollars, or it's basically a mad fund. And this mad fund is, in my view, it's very likely housed or siloed in the Exchange Stabilization Fund, which is an adjunct of the U.S. Treasury that operates outside of all law and does not produce financials and is unaccountable to nobody. And this thing is just operated at, I would say, at the sole discretion of the deep state, or the intelligence, ultimately the intelligence community, and it's utilized to prop up the U.S. bond market. It's utilized to suppress the price of metals, because metals price suppression is a very expensive thing to do, especially when you have entities around the world that have insatiable demand for physical metal. And so this slush fund is not acknowledged to be an official part of monetary aggregate data, as compiled by the St. Louis Federal Reserve, who's the keeper of monetary aggregate data in America. And it's beyond disgusting what has occurred with this missing money. Because when the missing money was first reported, the findings by Dr. Skidmore and his research staff at Michigan State University and Catherine Fitz, their findings were all posted on Catherine's site, solari.com. And what they did was because they were using the government's own financial data, they published their report with links back to the hard data, so people could go and look for themselves that this is actually what the government is showing, that the money's missing. So anyway, when they published this report, the first thing that the government did was they killed the links going back to the government data, and they thought that would make the problem go away. But it didn't make the problem go away because they had saved and archived all the financial data on Catherine's site. And if I can just show you, Catherine's actually now produced a hard copy book documenting the missing 21 trillion. And I can tell you, it's very interesting reading. And
yeah, I agree with you on that. I have that book as well, and I'm almost all the way through it. I think she says she's going to publish a couple more volumes as well in the future.
Yeah, they're coming. So anyway, as just getting back to what the government's response was to the publishing of this material. So the next thing that happened was the White House ordered a complete audit of the Department of Defense. And of course, the auditors came back and said that the DOD could not pass an audit. So then it fell into the laps of the Financial Accounting and Standards Board. And so what they did was to introduce a new piece of financial legislation called FASB 56. And FASB 56 says that the United States federal government is now excused from accounting, because if their books can't be balanced, and if they can't account for the money, then they can deem it to be in the interests of national security, and therefore they are entitled to keep whatever books they want. So that, I mean, this is, when you think about this, the United States dollar, which is the global settlement currency that all countries have to abide by. And we have this entity, Financial Accounting Standards Board, introducing legislation saying that America is excused from telling people in the world how many dollars there are in existence. And that's okay. Well, guess what? That's not okay. Because every country in the world has a vested interest in knowing that what they're getting in receipt for their output of their national, their national wealth, they have the right to know how much of that unit of currency there is in existence before they accept it in settlement of trade. And I mean, the American federal government is given a pass, and they're saying you don't have to have accounting.
Yeah.
Well, if you don't have accounting, nobody's going to do business with you and settle their accounts in your currency, especially when it's strongly and staunchly believed that you guys have cheated and created tens of trillions more than what you claim is in existence. And if you look empirically at what's going on in the world, we're told that dollars are scarce. Okay? But when is the last time you saw the American military have to wonder about whether they can afford their next military engagement? It's never happened. When has there ever been a question about whether the U.S. government can sell its next tranche when it's running perpetual budget deficits on an annual basis of over $1 trillion? When has there ever been a consideration of, can we sell the next trillion? Not only the maturing trillions that we need to roll over, but there never seems to be a consideration whether the market can absorb it. And the reason there's never a consideration, I would have it, is because these guys have trillions upon trillions of dollars hidden in silos that they can marshal that up anytime they need to, and and that's why when foreign countries dump U.S. government securities, like China has on occasion, and Russia has on occasion, and the Saudis have on occasion, the bond market never backs up. All that happens is if a country has made a major liquidation in U.S. government debt, it gets bought on the spot, and then rates rally.
Mm-hmm.
Well, you know what? That's not the way things work in the real world with free markets. Okay? It's just not the way things work. In the gold arena, when you have infinite supply of gold in paper, and the pricing mechanism can't tell the difference between a paper ounce or a futures ounce and a physical ounce, the price goes down. Okay, and in the debt markets or in the fiat currency market, if people understand that there's an infinite amount of dollars, guess what? The last dollar created in infinity becomes worth zero, and that's called hyperinflation, and that's what nature dictates should be happening. And the only reason it hasn't happened yet is because not enough people are fully aware of the degree of fraud and monetary debasement that's really occurred, because they've kept this fraudulently created dark money. They've kept it siloed and hidden from view. But I mean, we see the entrails and the evidence manifesting itself that it indeed is in play, because the operations that are occurring, if people want to take the time to understand them, like to get interest rates down to zero, requires a mammoth undertaking, utilizing derivatives and a lot of I'll just tell you, it takes a lot of bait to get people to fall for that kind of a trick, and there's a lot of money that needed to be put to work, dark money, I would have it, to get people to basically take rates down to zero and lower and into negative territory. These are very expensive operations to conduct, and this is not evidenced by, like, these things don't occur if money's really scarce, plain and simple. And if money was really scarce, there wouldn't be a negative value assigned to it in interest rates, period. I mean, you can rationalize that. I mean, the fact that we have negative interest rates tells you that there's too much money. Okay, and it's being improperly valued. So, I mean, so anyway, so America's no longer American government's no longer subject to accounting, and what that is all about, it's the deep state or the globalist entity, which to me are one and the same. They have their mitts firmly on in control of the monetary apparatus, and to be honest with you, I can only wonder whether Trump and the people immediately around him have half a clue as to what's really going on.
Yeah, I think some of what Trump is doing, he's trying to save the dollar, but I think he may be exasperating the situation and helping give the excuse for other countries to turn east. And the last kind of subject I want to talk to you about was Belt and Road Initiative and all of the agreements going on between Europe and China. I know that Italy has signed agreements with China, Germany has signed agreements with China, and the European Union just made an agreement today, it was on CNBC, with Vietnam, where they're going to remove 99% of the tariffs for Vietnam products into the European Union. So you've got Europe turning east now. What does that do to the long-term longevity of the U.S.? Are they being isolated, and how's that going to affect the dollar?
Absolutely. America's being isolated, but America's being isolated due to its own. And listen, something else I want to actually make a statement on. We refer to the American currency unit as the U.S. dollar. I don't consider it the U.S. dollar anymore. I really refer to it as the globalist dollar, because it's insulting to good Americans to refer to their currency unit as the US dollar. It's insulting to Americans because it's run by globalists. So let's call it what it really is. It's the globalist dollar. And this globalist dollar has been abused and used. And what we are seeing other countries doing with bilateral and multilateral trade agreements being organized, which America is not privy to or a part of, is that the rest of the world is getting very jiggy with the idea of what's been done to the dollar or the globalist dollar. And they are preparing for a day when the globalist dollar is no longer the exchange settlement currency unit. And that's what's going on in front of our face. You can embrace it and get your head around it, or don't at your own peril, because that's where we're headed.
Yeah, I agree. Okay, Rob, thank you so much for the interview. I appreciate your time very much and look forward to speaking with you again in the future.
Sure, anytime.
All right.
This has been a Gold Silver Pros production. Please subscribe to us on YouTube and sign up for our newsletter on goldsilverpros.com.